Hello and welcome back to Core Finance with me, Matt Brown, and it gives me great pleasure to welcome into the studio today Gaurav Sharma, who is business editor of IB Times UK. How are you today, Gaurav?
Good to be here, in a crude state of affairs, let's say that.
Indeed, and you mentioned crude. Today we're going to be talking about oil and crude. Really, it's been a little bit off the radar for investors. The reason being, we haven't seen the volatility that we've expected or seen over recent years. So what's driving oil or not driving it anywhere?
I'll tell you what, for the average punter, or let's say the enthusiastic spread better, this market is flattering to deceive. Each time you think there'll be some sort of a breakout, up or low, something or the other always keeps it within the range. And I think we're sort of stuck in this range. Now, it's good for, I should say, explorers in some ways, because they have a modicum of stability. They can handle this range, they can prepare their forward finances. And a lot of these oil majors are saying they're gearing up for $30 oil prices, whether or not it's there, they're still gearing up for that come 2021. So their forward planning is factoring in the so-called lower for longer era of oil prices. Now that's one thing. The other thing is some of these NOCs, some of these economies who are sort of addicted to oil, they're in a bit of a pickle.
Yes.
And I think what's happening is that each time we have oil sort of trying to escape the clutches of the sort of predictability that it's been in, something or the other happens. So if you take a look at the chart, we can run all the way back to the start of the year. So the first close of first Friday of trading, Brent was at 56.80. Now, in March, Mr. Khalid Al-Falih, the Saudi oil minister, made a bold statement, and we can see that, right? He said the oil market should not count on the Saudis all the time, and the impact was near instantaneous, and you can see that. And then, of course, everybody scrambled, and they said, no, we're still contemplating a cut extension. Cut the long story short, OPEC again meets 25th of May. And on the 25th of May, they extend their cuts, but they don't announce deeper cuts. So the market had already factored that in, and look at the response. The oil price sort of fell almost to $42. And again, we had those sound bites that let's extend the cuts, let's talk again. But OPEC is kind of losing a grip on things. It's not having the effect it used to.
Yeah, if you didn't know the statements back in May, 26th of May, you'd assume they were increasing production, judging by the price. And now OPEC, they're trying to talk the price higher.
Indeed.
And it's not working.
Can you imagine that OPEC has actually, at least on paper, announced a cut, and this is the response of the oil price, that it slides dramatically, and then another round of sound bites are needed. So I think OPEC's problem is damned if you do and damned if you don't. Now, last week, up and until Thursday last week, we had oil climb to about 2-month highs and was going upwards. And lo and behold, the IEA comes out with all its compliance stats, and I'll have to read this out. And the IEA says that there would be more confidence that rebalancing is here to stay if some producers, party to the output agreements, were not, just as they were gaining the upper hand, showing signs of weakening. And how is that sign of weakening? Now, the OPEC members, they've got 10 so-called non-OPEC players, including Russia along for the ride.
Yes.
But the OPEC guys, their compliance with the so-called 1.8 million MBPD, a million barrels per day cut, was on song. The compliance is somewhere around 115%. And that's now, for the sake of self-preservation, domestic jiggery pokery, that has now come down to 75%, according to the IEA. And you could see the response.
Yes.
So the 2-month highs were gone. And I think as we speak right now, oil is down, both benchmarks.
But it's the compliance side. I mean, it's all well and good OPEC coming out and talking about cuts, but the countries need to comply with that. And if they're not, it's almost pointless, isn't it?
I think so. I think it's. I'll not say it's a divided camp. I think it's a camp where its various members are thinking about self-preservation right now. Now, Ecuador, a very small part player, nonetheless an OPEC member, broke ranks quite openly. They usually do it behind the closed doors, but came out quite openly and said, we just can't cut. So we're out. Now, Libya has two alternative visions of where the poor country should go. And both, we don't know who to talk to, so Libya is exempt from this cut. Nigeria is also exempt from this cut. So slowly and slowly, who's left? And now, according to IEA, Algeria and the United Arab Emirates have also broken ranks.
Right.
So I mean, the pool is sort of narrowing. And what will happen, let's say, Now this current agreement, it's in place until March 2018, at least on paper. Suddenly, if the Saudis lose it, well, that's it. That really is it. Of course, there is some sign now. Let me give the long some joys. We've been having a very short. Let me give the long some joys. There are signs that global inventories are rebalancing, but I think that support will come towards the middle of the fourth quarter, not right now. Right now, if some keen punters are watching this broadcast, I would say to them is remain net short. Have your daily play on where the news is going. A few cents up and a few cents down. That's what we've seen over the last few days. And then perhaps try to extend your longish plays. Let's say when we are within sight of, let's say we're about 4 to 6 weeks shy of Christmas. That's when we'll get some sort of evidence. But right now, global inventories are still pretty high.
And if we just look at the chart again, where do you think this range will continue? I mean, that's.
I very much think so. I think we're stuck in this range because there are absences of political. If there's a huge political driver of some description, it has to be a major geopolitical event, not one of those sort of usual tit for tat exchanges between
North Korea that we've seen over the recent week.
It has to be something really major, like. And in the absence of that particular political trigger, I see it very difficult for crude to sort of escape this range. I think the average price this year is probably going to be somewhere in the region that we are. Would we look at $60 come Christmas? It's highly likely, but then that still would be a very poor reflection on the year where we have struggled at various points, struggled to hold 50. And we might still see Brent fall below 50, depending on how things shape out this week. Now, OPEC next meets towards the end of November, early December. That'll give us some indication. But I think what's happening right now is that whatever OPEC is saying is not really having much of a difference. But if anything, as we noticed last week, if anybody says anything negative about the so-called OPEC, non-OPEC deal holding firm, then the market reacts near instantaneously. So the bad news is factored in more easily than say some of the long calls that OPEC is hoping for. That's where we are.
Brilliant. On that note, Gaurav, thank you very much for joining us today.